Okay, you're quite bullish on the long-term prospects. Where would you put your sort of money to work in that environment then, given some of the short-term concerns?
Yeah, I think thankfully with China, you've got a huge sandbox of alpha-rich companies. Some of the areas that we like a lot are parts of the market that are going to grow irrespective of whether GDP comes in at 4% or 3% or 2%. An example for us would be the data center space and a company like GDS, which is the largest carrier-neutral data center in China. This is a hard asset infrastructure play, sort of like real estate, and it's trading below book value. And the company is not only growing quite nicely in China, but it's also expanding beyond China, particularly in Southeast Asia. So it's just one of lots of great examples where you can have non-beta exposure in the market. And the company, GDS, and a lot of others in our portfolio, they're also beginning to sort of take control and unlock a lot of shareholder value themselves instead of just waiting for the market to turn around.
Right. Beeneet, you also have exposure to DD Global, which was caught in the crosshairs of geopolitics the last time around with its listing in the U.S. And so how are you looking at, the whole Trump 2.0 rhetoric for China and some of these businesses?
Yeah, it's a great question. I'll give you a few pieces. The first one is that the largest degrossing episode in China has already happened. U.S. flows now play a minuscule role in the China capital markets, with U.S. holdings now being under 3% of ownership of the domestic market capitalization. And on a less technical note, people seem to forget that during the 4 years when Trump was president, the Chinese tech stock market actually outperformed the S&P 500. I think that could be a telltale. And I think starting point matters too. 3 or 4 years ago, we were at 30 times earnings on the market in China, and today we're at 8 times earnings. So exactly as you pointed out, DD is a business that's been left for dead. The company's not even listed on a major stock exchange. It's on the pink sheets. A lot of major funds are not able to own it. The company doesn't hold quarterly conference calls, and it will, over the next 1 or 2 years, go through that period and process of normalization. And in the meantime, you've got a business that's effectively the Uber of China, with a similar business size, trading at a fraction of the multiple it trades at, on our estimates, about 6 or 7 times EBITDA, when Uber would trade at 20 or 25 times EBITDA.
I also want to get your sense on why do you prefer PDD over Meituan or Alibaba, the bigger ones?
I think with every new cycle in China, you have winners and losers. And in our opinion, the winning portfolio of the next 5 to 10 years will look very different from the past. So there's entire pockets of the market where you're seeing this transition happen. We own a business called Kanzun, where you're seeing a transition happen from the companies that led in the recruitment space in the last 5 or 10 year cycle to the companies that are leading in this cycle. So one of the things we have tracked, we've got a team on the ground, research team on the ground locally in China, is despite the recession or the slowdown that's occurred in China over the last 3 years, are there companies that have taken market share? In other words, everyone has done worse than they would have expected because the economy has been quite soft. But some companies have lost market share. Other companies have gained a lot of market share. And I think if you could identify these companies that have gained market share, you stand in a much, much better position.